So now as we look towards Europe, we want to compare where things are in US and Euro real wage growth. And you can see how the wage growth has come under pressure in Europe. We're continuing to see that come, and it's, as we've been saying, Europe is a bit behind where the US is right now. And you're seeing them rapidly catch up. And that leads again to where are real wages. You look at, and for sake of time, because we've taken a lot of your time already, we're going to talk more about some of the European pieces next week. But when we look at Germany, you had wholesale prices explode in January, up 2.3% month on month, 16.2% year on year. You have inflation remaining elevated, but the surveys, the expectations came down. The current situation went expected at negative 6.5%, came in at negative 8.1%. Those are the fears that we continue, and this is one of those big drivers on why and how we think that there's going to be those slowdowns in Europe. Real income growth is now under pressure. That continues to be the case, and it's just important when you're looking at the consumer, because the consumer has been, it was never as good in Europe as it is in the U.S. And now, so it was starting from a weaker footing, and now you're seeing an increase in pressure, which I think is not being appreciated on what that means for local consumption and local growth within the European zone. Trade balance came under pressure. We saw a big increase in imports, with exports coming down, but that is also kind of a positive in terms of where imports are coming through. You're gearing back up. You have car manufacturing that is picking back up. That needs a certain amount of pull through. So we're seeing some of those pieces get a bit better, and we're seeing some of that catch up, which again is more positive when we're looking at some of those movements. Now, when you look at inflation, though, inflation has broadened. So it starts out as just energy, and then it goes into housing, and then it goes into food. And now you're seeing how inflation is a much bigger problem and growing. So the consumer price index, the share of goods and services whose inflation rate adjusted for the VAT effect, has changed accordingly in the past 12 months. You're getting an idea of just how much is increasing and how you're seeing that ramp up. And we don't see that slowing. Even the core CPI is surging back up. And these are those pressure points, the problems that we keep seeing crop up, and that I think is being ignored to a point of almost, painfully speaking so, where the ECB is going to have to take some sort of more aggressive action to try to stave off some of these pressure points and some of the problems we continue to see grow. Now, when you look at goods prices, still the main driver of inflation, that leads back to imports. They're increasing imports. Import prices are through the roof. So you're still seeing a big increase in terms of just the goods coming through, and then that's going to increase the price of exports. That's going to increase the price of the local prices, which is going to put more pressure on real wages unless they can get those wages back up. And we just don't see the capacity to do so, given some of those offsetting costs. Then when you look at the euro area, companies reporting lack of labor force, a hinder for growth, that continues to be a problem. So you can't pay higher wages, but yet you can't hire people. So that's the conundrum that, again, it's not just a U.S. issue. This is a global problem, and Europe is not exempt from these issues, which continue to expand, which again becomes that underlying issue becomes that underlying problem, that underlying driver of pressure into the underlying sales. Euro area inflation versus historics, you continue to see how the estimates continue to miss, and we expect that to continue to miss as we do see more upward pressure in inflation giving way to more stagflation. So we don't see this big drop off. Now, it's something more of a sideways move, which becomes, I think, a bigger issue for where European growth can be and what they're going to do in terms of their exposures, not only to Russia, but also to China, as we have an increase in pressure from Russia, from China on sanctions and pressure points, which are going to increase underlying prices for consumers. And this is just looking at Eurozone PPI, roofing, just showing that, again, the tip of the spear on where these pricing problems remain and how this is going to continue to be an underlying problem. Now, when we look at change in terms and conditions on loans or credit lines to enterprises, here you're getting an idea of where those pressures remain. Overall terms and conditions, they're still good. They're still in a better form, but you're starting to see some financial tightness, which is giving way to yields are no longer negative. Again, they're talking more real yields and nominal yields are moving into positive territory, which is increasing some of the underlying riskiness that people will take and what the cost of doing business really is. Now, factors limiting production and activity continue to grow. You have the shortage of space and equipment. You have the underlying shortage of labor. There's a lot of things that are just increasing the cost of doing business throughout all of Europe. This is not just a European issue. This is also not just a US, again, global. And this is why we continue to see these pressures within Europe. As we've highlighted in the US, it's just they're a little bit further behind in realizing some of their problems. Eurozone sales dipped, and again, this is also not adjusted for inflation, so to give you an idea of how much pressure is there. Google trips to retail and recreation starting to normalize a bit. When you look at where things are, you're getting some of that bounce. Again, the chart doesn't reflect that completely yet. But some things, some COVID restrictions are lifting, which should support some of those sales. But how much of it is being impacted by falling wages and underlying pressures, which is something that, again, the Eurozone was never starting from a strong footing, similar to, unlike the US, which again creates some of the underlying pressures that are going to be extrapolated and a bit worse in Europe. Then when we look at Germany is expecting to lag other Eurozone countries is a bigger problem because they're the largest country in the European Union, in the Eurozone. So without them growing, again, that's going to mute some of that capacity. We've talked about how we thought Italy was going to be a bit more of a driving force, but Italy's size and Germany's size is going to be vastly different. But now you're seeing credit spreads in Italy, costs going up exponentially more than others due to their elevated amount of debt. And that's going to put some pressure on our view that Italy is going to be able to grow a bit stronger. Germany is a nation of makers, which comes down to why exports are so important, but they're going to be very much subject to import prices and what their partners are willing to take, which is why we remain concerned given, cost, as we said in segment one, they have some of the most exposure to Russia outside, when looking at the main drivers of the Eurozone. Yeah, obviously, Eastern Europe has more exposure, but Germany's the third largest, and they're the largest out of all of France, Italy, Spain. So that's going to become a bigger problem, which is why they're a bit softer on kind of where they stand and a bit more wishy-washy on Russia because they're the ones that are going to be hit the most. They're going to see the highest cost, and they're already coming from a very weak standpoint. Auto production is increasing, as we said, which is one of the reasons why imports have increased. We should see a cycle back with exports going up, which will be a net positive, but it's going to be at a much higher price, again, eating into some of those profit margins. Then when you look at retail sales, they're set to soften in Spain, and that's something that we continue to, and again, even as COVID comes, kind of fades into the background, there's other issues at play. It's not just coronavirus, and that's what we've been trying to get at. There's a lot of problems, and Spain is facing a huge impact by inflation and what real wages are, which is going to continue to drive some of those issues, as well as the lack of tourists and what that means for global trade and some of these countries that rely extensively on tourism. So German manufacturing orders have bounced, but production has remained muted. So again, there's still some of that driving piece on some of that industrial production coming back, which will be a bit of the tailwind to help offset some of the spending in services in the consumer. So again, manufacturing PMI should remain strong, while services PMI we think remains under some deep pressure. So now that we kind of flew through Europe, and we'll get more specific on countries next week, we want to go a bit more into Asia and some of the things that are happening there. This will also be a bit more high level, and next week we're going to do more on Europe and Asia and a little less on the US to balance out some of that macro backdrop.